So, okay, we got our research piece for today. I wanted to kind of go back to basics a little bit. I was kind of talking about some more advanced concepts, talking about volatility modeling, talking about, stock forecasting and stock price modeling. But the more that I started putting those pieces together, the more that I realized that it would probably be good to kind of go back to basics a little bit and build up a foundation for that to make a little bit more sense, or for it to be a bit more intuitive. So today, I just wanted to talk about something that's very simple, but also very complicated, which is measuring risk. I wanted to so risk, again, it's a complex concept. There are many different elements to risk. And this is not just true for markets, right? It's true for pretty much anything that involves any degree of uncertainty. Risk is multidimensional. And so in order for us to really more completely understand risk, we sort of need a number of different metrics. And traders tend to use forward and backward looking metrics in order to really complete a profile to understand the different risk factors that might be affecting an investment, whatever vehicle might be used. So what I want to do today is overview some common historical metrics as part of the series and really talk about the pros and cons of each. So this is more from a higher level overview, just to kind of like understand what some different common ones are used for understanding the risk of a single asset historically. Does that make sense?
Yes.
Cool. Okay, so measuring the risk of an asset. Again, pretty loaded question, right? Because there are many different sources of risk, many different elements that can sort of introduce volatility into an asset. But there's kind of two broad classes of risk metrics for measuring the risk of a specific asset, not so much looking at the relationship between multiple assets, like correlation, for example. But when we want to understand the risk of a specific asset, numerically or quantitatively. Generally, we would look at either historical metrics using historical data or forward-looking metrics using some kind of mathematical model to estimate the different risk factors or predict the different risk factors, whatever that might be.
Yeah.
So the historical metrics that I personally want to focus on today are historical volatility, which is just the standard deviation of returns, usually daily returns. Beta, which I don't know if we've talked about before on the show, and then conditional value at risk, which we talk about a lot when we show our trading. But today I just kind of wanted to recap exactly what that is and what it sort of means mathematically. In some of the future segments, I want to talk about forward-looking metrics. So what do these distribution statistics look like from simulated data? Then that also begs the question, so it's like, how do you simulate a stock price in general? And then some sort of more options-derived forward-looking metrics, implied volatility, which can be very helpful for understanding expected range. So you can apply it to stocks, even though it's derived from options. And then you also have more options-exclusive metrics, such as the Greeks and such as buying power reduction, which can also tell you about some extreme losses for undefined risk positions. But today, we're going to focus on historical metrics and really those big three, which can tell you a lot of useful information about risk. Does that make sense?
Yes, perfect.
Very cool. Let's start with historical, maybe the most ubiquitously used of them all, which is historical volatility. We talk about volatility all the time. It is incredibly useful. And when we talk about historical volatility, we're really talking about the standard deviation of a returns distribution, so of a historical returns distribution. So here we have SPY data from the last, I believe, 15 years. 15 years. And here you can see the different possible returns that were recorded for each of these different sort of buckets. So you can sort of see from the standard deviation, what this tells us is really the spread or uncertainty associated with that distribution. And here, again, we're looking at daily returns. So when we talk about standard deviation, when we talk about historical volatility, we're really looking at the uncertainty associated with our sort of average expectation for daily move. So, for example, Amazon might have a much larger standard deviation historically compared to SPY when we're looking at the returns distribution of the two. What that means is that there's more volatility or more historical risk associated with that, because when we have our sort of like average expected move, for example, or average daily, what we can expect on a daily basis, there's more uncertainty around that measurement and more variability that measurement can potentially have. So for historical metrics, is really one of the most common one when we're looking specifically at returns. This is really what we tend to use. And the pros of using historical volatility is that it's very easy to calculate, and it also gives you a range of the most likely outcomes, at least historically. So I can say, sort of like neglecting binary events, the distribution or the daily returns for SPY on daily basis can really range between these two possible values. So it's around 1% is plus 1%, minus 1% is roughly what SPY is going to return on a daily basis in most cases, at least based on the historical data. But the cons of using this are that it can really misrepresent risk factors for non-normal distributions. So, right, we talk all the time about how stock returns are not actually normally distributed. We often exhibit some kind of skew, which is like asymmetry in the distribution. We often see kurtosis, which are some fat tails in the distribution, so more likely outlier events than what the normal distribution estimates. So there are some limitations to using historical volatility, but it still gives you a decent estimate for the range of possible outcomes when we're talking about these probabilistic events, right?
Yes.
Historical volatility, very common one that's used. The next one is beta. This is another pretty common one. Beta is one that we don't talk about a ton on the show, but it's still very helpful, especially with like portfolio management. This is really a measure of systematic risk. So it really quantifies how much volatility a stock has relative to some benchmark, some volatility benchmark, which is usually the market. And here's the formula. You don't need to know or understand the formula to be able to use it. But again, putting it here for completeness, it's really the covariance between the returns of an asset, returns of the market, divided by the variance of the market returns. And typically, again, we would use daily returns for this. Which again kind of tells you like how volatile some asset is relative to your benchmark volatility, which is usually the market. So the way that we would read this is usually broken down something like this, where if beta is greater than 1, then the moves of the asset tend to be significantly more than the market. If the beta is equal to 1, it pretty much matches the moves or the volatility of the market 1 for 1. If it's between 0 and 1, it's a little bit less than the market. If the beta is 0, that means our volatility is kind of independent of these systematic risk factors. And then if the beta is less than 0, the asset movements tend to be inversely moving from the market, right? Does that kind of make sense?
Yeah.
So this can be, again, incredibly useful for measuring volatility relative to some benchmark. This, for example, is SPY in NVIDIA. The beta is really just the slope of this line. That's one way to interpret it. And the beta for NVIDIA, between NVIDIA and SPY, right, between 2023 to present is 2.35. So significantly more volatile than the market over this period of time, which is not surprising for anybody who hasn't been under a rock for the past year. This, again, some of the pros of using this is that it's very easy to interpret, but it also gives you a historical representation of market sensitivity, which can really matter if you're trying to get some degree of diversification and you're trying to limit the overall volatility contributions that an asset might have to a portfolio. The cons of using this are that it really focuses on systematic risk. So there's certain like sector-specific risk factors. So for instance, like NVIDIA in the semiconductor space has certain semiconductor-related risk factors and certain company-related risk factors that wouldn't be accounted for in something like this. This is just looking at systematic risk, so the risk that's really tied to the market as a whole. And then the other sort of limitation with using this is that it requires this relationship to be one linear, and here we're seeing that line get drawn. So if it's a nonlinear relationship, that causes problems. But number two, it also assumes that this relationship between the asset that we're studying and the market is going to stay constant, which is not true, right, necessarily. It's an estimate that we can make just to get an idea of how much historical risk or volatility there was historically, right? But there's a limitation that comes with that. And those are kind of the pros and cons of beta. Does that make sense?
Yep.
Cool. And then my personal favorite, I think the favorite of any options trader out there is conditional value at risk. So conditional value at risk is based on value at risk. So value at risk really gives you the estimate of a potential loss for a portfolio or a position over a given time period at a given likelihood level. So for example, value at risk could be at the 5% likelihood level. Over any 1 day period, one can expect to lose at least $1,000 at most 5% of the time. It's really giving an estimate for extreme losses. So here for SPY, for example, again, looking at that returns distribution, the VAR is negative 1.6, about 1.7%, right? So what that means is on any single day, in maybe the worst 5% of cases, we can expect to lose at least 1.7%. And again, we're using daily returns here. So that's what we're kind of basing this statistic around. That's value at risk, which is really just that slice of the distribution of that 5% likelihood level or that 5% worst case scenario level. Conditional value at risk is based on value at risk. We basically take that slice, the value at risk slice, we look at the tail, and we take a weighted average of that tail. So this kind of gives us an even more extreme estimate in the worst 5% of cases. So that's really all that it is. It's not especially useful unless your distribution is really heavily skewed, which for options traders, the P&L distribution is skewed. So that can have some more applications, I guess, for other types of assets, but just to visually understand it here, we're using SPY. Does that kind of make sense?
Yep, totally.
Yep. So then our conditional value at risk for SPY on a daily basis is 2.6%. So if we want a more extreme estimate for sort of worst case loss at a specific likelihood level, that would be 2.6% for SPY over the time frame that we're looking at. And then, yeah, so the cons I've maybe mentioned a little bit. The pros are that this gives a better estimate for extreme risk for highly skewed distributions. The distribution for SPY is a little bit more, fairly symmetric, so it might not be particularly necessary for this, but it comes in real handy for heavily skewed distributions. The kind of cons of using this, it can be a little bit complex to calculate. It can also overestimate extreme risks in certain circumstances. So for example, if a company has earnings, right, those tail risks might have been heavily influenced by earnings. So if earnings is not coming up, then if we look at this distribution as a whole and those earning events are accounted for in there, then this might overestimate our realistic risk factors on any given day. And then, right, as I've said, this can be maybe a little bit unnecessary for more symmetric distributions, although I will say even for the S&P, I think for me, this is incredibly useful. I think it's more useful the more skewed your distribution is, but even for more symmetric distributions, I think this gives you a really good historical representation of what loss can look like in potentially detrimental situations. Make sense?
Yes.
See, easy peasy. So to conclude our first intro piece talking about historic metrics. So we know, right, all historic metrics are going to be fundamentally limited by the fact that the market constantly and uniquely evolves in time. The market today is fundamentally different than it was yesterday, than it was last week. But when you take historical metrics with a grain of salt, they can be very useful for at least even quantitative estimates around certain risk factors, giving you kind of a scale around what those risks could be based on historical information. And the major metrics that we covered today were historical volatility, beta, and conditional value at risk. Feel free to put your favorite historical risk measure or just general risk measure in the comments or in the chat. That's all I got.